Holy moly, I don't think I've ever been trolled so hard in my life until today, seeing a big red day, as if we weren't prepared for a down day or even a continuation. In today's market brief, we got a lot to talk over, but I want to really cover drama and why there was an increased amount of drama in the markets today, and as well as an increased amount of emotions. One quick tidbit before we get into the show that I want to share is, if you feel very emotional, chances are that you are putting too much out into the markets. Or if you have the need to feel right and not willing to pivot, or you're too hooked on one feeling about how things should be, but the market decides to go another way, you will get destroyed in the markets. So you must start off paper trading or lower your positioning sizing, because drama can continue, and that can go in either direction, to the upside or the downside. You're watching the Daily Stock Market Brief. My name is Michael Silva. This is the show that I do Monday through Friday, 5 days a week. Today's date is February 25th, 2021. Big down day in the markets. So let's get into today's show. Hey, what's up? Welcome back. Look at the dashboard. Just blood red across the crime scene here, except for the VIX. Obviously, the VIX goes up, right? So utilities at the top, right? Well, utilities are kind of a bond proxy, okay? So that makes sense. They're up there at the top. We have consumer discretionary at the bottom, took the biggest hit. Technology, materials, and so forth going down the list. Now, I want to preface this all, like I said, by talking about drama. So when you see big, large red candles, okay, or even big, large green candles, you're going to get a lot more emotional about that specific day. For example, if there's a large range green candle on the screen, you're going to feel hopeful, especially if you're long. All right, and if you're short, then you're still in the position, you're going to feel horrible. Okay, and flip that to the red side of a candle. If it's a big, from an open and just a solid red candle that we saw today, which we'll get into those charts here just in a moment, you're going to feel, fear and panic, and you're going to have those type of emotions. So during the day, I posted many different chart setups. Okay, one was around the DIA for playing a very quick bounce. But because people don't understand the context in which I'm speaking, instead of asking, they assume or say things like, it seemed like this. You got to pay very, very close attention, or ask for the context. If you're watching me on Twitter, or even if you're listening to anybody, have them explain the context. You need to listen to understand. You need to remove biased beliefs and try to understand somebody's point of view. That's the only way you can learn and get better in these given times. So we had the market really ripping down to the downside. Okay, this is just one example. I did the DIA, which I caught a 50-cent bounce on, but at 9:59 here on Twitter, I said, SPY, getting ready to play a bounce again. All right. The reason I posted this is because it was pulling into another area of support that I mapped out the day prior. All right. So on the daily time frame, I was looking at a level of support, and I was looking at very overextended candles. So these big red candles to the downside, creating all this emotional feeling with many people, a lot of fear. So what happens is, when it's just like a rubber band, right? You get stretched out and then it stretches back. So at that time, I said I was getting ready because it was pulling to the area of support. We had some overextended candles. So instead of going in short into an area of support, you need to fade the emotion that's currently in the market. So this right here is fear. So if I'm going to be fading fear, I'm going to be looking for optimism. So I found that optimism, played it at 10 o'clock. You could see it. And then boom, we bounced to the upside and we continued to move higher. I didn't hold it in this entire time. I just doing scalp trades today to work around my silver position that took a nosebleed punch hit today. Okay, that was one of them. Then the next one, okay, that was a bullish context. You can see the bounce. This is on the 50-minute time frame. Okay, people ask, like, can you explain how you saw this? We mapped out these levels. I mapped out these levels the other day on the daily time frame. And then, like I said, I was looking at various other indicators, such as the RSI on the 50-minute time frame, getting into that overbought to oversold territory. On this one, I saw that it was getting rejected by the 20 period after the bounce that we called out. And then we saw ran up into the 20 period, and then it got rejected, and as well as the VWAP. So then when the next candle opened, I then submitted this as an alert, 15-minute time frame, struggling to crack above it, and then plow, it obviously kerplunked down later. Now we're kind of sitting there at this little double bottom, okay? So we're going to get into the indices now, but the reason why I wanted to explain that and the thought process is because it's important to understand whether you are deciding because of emotion or if you planned ahead of time. All right, there's a big difference between the two, and it's okay to disagree that, like, for example, right here, if it keeps going down and I see this candle and I say, I think this is a good area to go long, and you're like, I don't see that at all, that's okay. That's totally okay to not see it. But what you need to understand is why somebody else might see it, okay? If you understand why somebody else sees it, then that could help you understand why we get these type of bounces, or why I said all of a sudden right here, I would flip my position, okay? One, the candle looked miserable. It was running into resistance on top of that, so it just seemed likely to see a breakdown. I didn't play it because I was done for the day, but I had to call it out. Okay, so let's go into the indices because, like I said, there was a lot of fear in the market. Everyone's, is this the crash? Is this the crash? Well, structurally speaking, nothing's actually broken yet. Nothing. So we had a scary day. See the big red candle? All the drama. All right, you gotta pay close attention. We opened here, and then all the drama. What did we say in yesterday's market brief on the Wilshire, the broad market index? We said, okay, first off, it looked like the hammer candle we called out, and then we got the up and away video right here. We saw the follow through, and then we said what on the Wilshire? This is a morning star pattern. What do we need? We need confirmation to the upside in order to confirm it and then crack above the all-time high. Where did we open? We matched open and fell straight down. Now, structurally speaking, we're not completely broken down yet. The MACD doesn't look good. We're still above the year open, right? So we're still positive on the year, and we're above the 50-period moving average at this time. We had scary days here too, and we pulled into the 50, and that was one of the best rallies for the year. I mean, the year's not been open for that long, but you can see that was the best rally for the year. So could this be the second best rally for the year? We need to stay open to the idea that the market can still press higher. Meanwhile, be prepared for if the market will continue to roll over. Does that make sense? I hope it does. S&P 500, once again, we're still within the bull channel. We're still above the 50. We're still above this gap, and we're still positive on the year. The big, large range candle threw all kinds of emotions and drama out into the wind. So we're seeing a lot of scared things. Now, if you watched my market brief a few days ago with the thumbnail that said critical, we were talking about the fact of rising yields could put pressure on the markets, and we've been seeing that. We've been saying that. I even made a market brief about, it said yields and Powell. All right, so for 2 days, Powell was, the last 2 days, Powell was in, the market was doing decent, right? So boom, boom, those 2 days we recovered. However, as soon as he's out, all eyes back to the yield. The yield continues screaming higher. So, what's the market trying to say? Like, the market's saying, yeah, inflation is going to get out of hand. I don't think that the yields are going up because, they're pricing in growth right now. This to me does not seem that way because they're pretty much going vertical at this particular point in time. So on this daily time frame, I'm getting off topic. The 20 is still above the 50 and it's above the 200. This could be the start of a bigger drop. It could be, but we need confirmation. Does that make sense? So understand this. So how would you, what do you look for, what do I look for if this were to break down? Well, if this were to break down, I would be looking at the year, okay? So just above 37.50, that can act as a level of support. We opened here, okay? We broke down slightly, bam, we recovered. So that could be an area of support. If we start continuing to break down, we can get even more aggressive on the downside where we can start looking at 3,500. It'd be a pretty large range here, right around that 200-period moving average and this high right over here. So we can call it, 3,600 to 3,650 could be a level and so forth. And then you would just want to tag in stops. This is not a market that you necessarily want to short one way, but you can short it if you're hedging other positions. Right? So if you just go a one-way sided short and, you don't know about theta burn, you can get destroyed very simply, especially by entering into an overextended candle. So this right here tells me that we'll probably get retail traders buying in puts, and they may get lucky for a continuation to the downside. However, inexperienced traders that they buy on these big red days and then they're like, oh, this could be the start, don't understand that on big red days, we've been having significant green days to follow. All right? So that is the tail risk. You want to be able to short at the higher end range of resistance. So yeah, 3,900 could make sense, right? But keep in mind the context of the chart. There's definitely other individual names that look severely more capable of breaking down. Then we got the 30-minute time frame. I'm going to move a little bit quicker. This is pretty funny. So 30-minute time frame, we could not get above the level of resistance. The VIX did not fill this gap down here, so not too much trading opportunities other than a couple of bounces throughout the day. And then this pattern that's actually forming, you got to pay very close attention to this. This is called a launch pad, okay? This green area of support right here looks like a rocket ship, and it's going to go whee. All right, that was just a joke. But we could potentially see this as a double bottom at 380.5. So that's always a possibility. Have a tight stop loss if you're going long, because if we do get follow through to the downside, it could be very dramatic to the downside, right? Another call out that I want to say is this right here is a positive divergence. So you can see a low here, a lower low here into an area of support. And then we have a little higher low right here on the RSI. So something to call out, something to look at. Rocket ship, Dow Jones, daily time frame. Still holding strength above the area. Very big dramatic candle as well, okay? Big green candle, big red candle, bearish engulfing. It didn't get quite above the other day, so it's not a full engulfing, but it's a dramatic down day, to say the least. Now, still above the 20 period, still above 31,250. You know, it's funny, it tagged 32,000, and that was the target from that previous video that we did about the descending broadening wedge. So if that was the top, that's pretty crazy to me. I doubt it. I don't think it's going to be the top. Maybe, perhaps, but I don't know. Not yet, until we get some more confirmations at least. Price percent oscillator has not flipped to negative yet. Still above 0, and it's still technically in bullish context, but it does look like it wants to do a bearish crossover. So we'll be keeping an eye on that. For the year, the Dow Jones still remains up. And I'm looking at the industrials right now. All right. 30-minute time frame. Okay, this is what I posted intraday, and when it was right around this range, I said, okay, get it ready, because we can get a bounce from this resistance, right? Once resistance is broken, it then becomes support. Well, you can't see it here, but we had a very small bounce that lasted about 50 seconds. So if you were a scalp trader, congratulations, you caught that. But it was not really worth noting on the 30-minute time frame. This right here looks like a bull trap, all right? So it moved in, boom, could have been a bull trap. Now, I want you to pay close attention to this. Why would I say buy in down here? Okay, because a lot of people said, I don't know, that's too risky. It's not too risky if you know how to manage risk. Okay, so first off, the sense behind this and understanding this is there's resistance, it breaks, and then can become active support. That happens all the time in the markets, okay? So if you were to be able to buy here and have a very tight stop loss, okay, you're not risking much at all. Okay, so if you were to risk, and you play this very small, zoomed in on like a 5-minute time frame, and you risk it, 20 cents, 30 cents, whatever the case is, you could have went and caught a 50-cent bounce very quickly. Now it started to head down lower, and at this point, right around 10 a.m., that's when I started also calling out about the SPY being at the bottom, because this was coming down into the 200 period moving average, and then we bounced as well, creating that rocket ship pattern, and this level of support did still hold, as well as the 200 period. So looks like a bull trap. Maybe we revisit that level again. Maybe we don't. It's very hard to tell. But what you can say is, or what you can look for, is a breakdown of 313 or a confirmed close. Could see dramatic downsides to around 311 to start filling some of these gaps. If we get back above 316, that could send us like on another trip like this. So we got to be prepared for that as well. I'm not in front of, I don't have the futures market in front of me right now, so I can't tell you where we're at exactly, if it looks like we're gapping down or not, but, just pull that up after you watch this video, and it could help give some context. IWM, we did break down through this bull channel and close the 20 period, through the 20 period. Price percent oscillator is still trending down. That has been that little warning sign right there. So this actually looks more bearish than most of the charts that we've been looking at. Immediate support would be right around 210 at that 50 period moving average, right around that gap. And then also that could line up pretty much where that resistance and support was right here in this level too. So that would make sense to me. NASDAQ, we're gonna look at the Qs. What did we say about the channel? We said, okay, well, it has to recapture the channel, but you got to keep an eye out for, if it does start rolling over, it could maybe be a head and shoulder pattern. And, it's not that built of a shoulder, but you never know, it could build out more as a shoulder, or this could be just a very quick little tiny shoulder. So we had the left, the head, the right shoulder, and we got, broke down through the channel. We back tested the channel. We're still well below the 5 EMA, well below the 20. I would start looking for a break below the previous low, and we could potentially head lower. As yields continue to move higher for tech, they've not been doing well for, they just haven't been doing too well at all, especially when we start seeing these yields move up higher. So play with caution, because yields, once we get into that section, it is in this area of support. And, if they do continue screaming, we can still see the market, they're relatively low, but like that could put some pressure, even more pressure than what we're seeing in the equity market. But if they do start to turn around, or if we get Jay Powell to just say something about yield curve control, the market can just melt up. It can just go on a monster move back to where it came from. All right, so here's the cues. This is a 30-minute time frame. Look, we drew out this bear flag, and it opened up and immediately broke down and did not retest it. So this was a bear flag, played out completely perfect. So if you got to catch that, awesome. Did want to call out the positive divergence here on the RSI, and it could be considered a double bottom here as well. So a lot of charts are kind of looking like that. We'll see. Maybe we break down through 311, come back to back test it, and then head lower. That's a possibility. Or maybe we stay above it and start moving up higher. If we do start moving up higher, I'd like to see it get back above 317, which is this high right here, and then recapture that 50 period on this. That I'd feel a little bit more confident putting in a higher low. Versus a lower low. Let's look at some indicators. The VIX is on fire. Holy moly, that was a big spike to the upside. I can't wait to get into the lumber to gold ratio. I brought in that again, the 3-week, because, kind of forecasted this. If you watch a couple videos back ago, again, it was negative, but we'll get into that. But 25, once it finally got above that level, we really started seeing it screaming. Now, here's a bullish case, a bearish case. So first off, the bearish case is that we can get more vol continue to the upside all the way to 37.5, right? To the upper range of this channel is what I would be that target area, where if we did get up there, then I'd really start looking for a lot of long positions, because that would make sense to me, and it would make a good risk versus reward. From the bullish perspective, you could look at this and say, well, it's actually running in to those the low 30s, which 30 has also been a level of resistance. So when we get into those areas of 30, we see a pull back a little bit further. So you can see it right here, boom, to the downside. So it could potentially be a very, how Keith McCall says, episodic and non-trending event right here with this vol spike. We'll find out tomorrow if the volatility wants to continue and burst through this channel. If it doesn't, this would be considered episodic and non-trending, which would mean that the market is still in store to move higher and not follow through on this aggressive downside risk. Okay, so that was a lot of words, but hopefully it made sense. BPNDX still in oversold territory, which means two things. What did we say? First off, bullish perspective is oversold. It could represent a bounce. We saw that already once right here, and multiple other times. The other thing, though, to keep in mind is breakdowns take place in these areas as well. So even though it's oversold could remain oversold for a long time. As we've seen certain charts with the RSI, right? They've been overbought for a long time, and they've continued to make new highs. So it's always something to consider, and they're at critical levels. So what you do in these cases is you look for areas of support to buy into to potentially catch some bounces. That's why I like using the BP charts. Here is the BP SPX, still has room to go lower, still has room to go higher, no change there. Here is the S&P 500% of stocks above the 200 period moving average. We did fall down to a 82.77, so heading down lower, that is normal, so that's good to see that. It's been jammed up here above 90 for quite some time, and it has been building out that negative divergence, and it's starting to play out down to the downside, so we'll see if this continues. Then we got the NYMO. This is breadth. We got a big spike down to the downside, but not nearly as spiky as we saw over here, which suggests we could still potentially have more room to extend, or, potentially not. It's just very difficult. It is playing out very similar to what we saw here in 2020. We've been calling that out. We'll see. If it comes down to this minus 80 level, tomorrow on a big down day, then we might see a little bit of rip, a small bounce type sort of move. We got to just pay attention to it. And then if we get like this energy burst to the downside right here, that could even, that could represent even forceful moves to the downside. I would say that 3,700, if we start cracking below that, that could be, we can see an easy shot down to 3,600 because there's really nothing between that area. So that little range in there would offer up potential good area of support and a buying opportunity, but we'll get there when we need to. Here's the new high. Oh my God, the NYSE high-low index, been jammed up super high. Now we're starting to come down to the low 90s. Oh my gosh, finally, just take a breath already. Holy moly. I mean, look at the past, how it's acted, and then look at here. It's just been jammed up. This needs to happen. It needs to take a breath. But we're starting to see it come down a little bit, but it's still overextended to the upside. Okay, it's still up there. Here's the lumber to gold ratio. 13-week rate of change is what we're looking at here in the middle. When it goes below 0, that's risk off. It is still well above, so it's still risk on. Now, on the 3-week rate of change, I want to show you something. I brought in the VIX here too, because what this is really good at doing, and we talked about this on Michael Guyad's interview, is he doesn't use it necessarily. He might use a 3-week, but he said the 3-week works well, but you have to trade more frequently on it, so it can be wrong more often. But he did add that it could be right sooner. All right, so the other week, or whenever that was, I think a day ago or 2 days ago, it fell below 0. We called that out on the indicators, and that then suggests the potential for volatility. Now, you don't really technically need to go risk off until the following week, but it was still there, and we still called it out below 0. Now, when it goes below 0, it's saying that the conditions for something to happen in the markets is taking place, or could take place. It's saying that the conditions for something to happen are there. And what I want to call out here is, for example, when we cross below 0 here, look at what happened in the VIX. VIX volatility spike, okay? And that's when the market crashed, okay? When it came down here, right there, you can come down, the market went down lower, and you saw that vol spike. All right, so it's played out a few times, crossed down here. We saw a little just wick up, but then it kind of came back down. It was relatively flat in the S&P 500, so that was a wrong time. And then we cross down here, and look at, we're starting to see that uptick right here in the volatility. So are we going to see something crazy like break above 40 and then really start to scream higher? Is that this early warning, or was that it? Was it episodic and non-trending? Is what he always says. So that could be it. That could be the case. But these are reasons why we've been a little bit more hesitant, more careful, and not throwing, as I've been saying, caution to the wind. Let's go into commodities. Here's gold. Gold, horrible day, down 22.50. As the 10-year continues to spike, gold continues to just fall. So continues to move down, lower highs, almost lower lows, still holding at this, 1770 level. 1775, 1760, that range here. So it was resistance, and now it's acting as support. But the bears are getting it closer and closer to destroying their area of support, which could forcefully push us down further. Now, I don't have the yearly chart on me, but I did look at it today. And still, when you look at a yearly chart, this is just almost like nothing. From a larger perspective. So there is targets that I have around 1700, I believe, is where the start of it takes place to repurchase in to get some more gold. But I bought down already at these low levels and way below that. So I'm still in my core position, which is not something that I trade. It's something that I, hold on to. And that's just a part of my portfolio. Silver, I own silver too as well, and I got into the miners yesterday. Down day today on the junior miners. Junior miners are more volatile, so those were down around 5 or 6%. So I did a lot of my time today was trading around those positions to make up for those losses, which, by the way, it was a small position, so it's not a lot of losses relative to my portfolio size, that is. So yeah, down day, minus 17 cents, but it's still trending up right now, okay? I still believe that we're going to have up days, we're going to have down days. We got to start considering this more when trends maybe potentially break. So when this resistance was broken, that is when we had the new support that we can mark out, and that support has still held up till now. The price percent oscillator is having a lot of trouble here trying to figure out momentum either to the upside or the downside. As I see it right now, when you look at the moving averages, they're both sloping up, good slope, and you have this support, the trend line there is support. So this, to me, is still a good opportunity. It could still very well be a nice big cupping pattern and take a while to play out, but you want to be a part of it if it does play out, because when it moves, it can move, and it can move at a rate that, you're going to want to just forget about it. If if it moves 14%, 20% or something crazy like that in these individual names, you'd be like, oh, no, that's a little bit of an overextension. Maybe wait for it to pull back, and it might not. Who knows? We've seen some pretty huge pullbacks, and I'm not trying to get anybody hyped up on it, but I have a position. It's not that big, but I'm building a position out as we speak. So I do like the down days, so I can add to it. Here is Bitcoin. Bitcoin didn't do much today, really at all. So yeah, headed a little bit lower, but that's really it. So surprised to see, actually, because the markets were just, all over the place. And Bitcoin, I guess maybe people's focus was just not on Bitcoin as much today. I didn't see it in my feed at all. People weren't touting it as much. It was just a quiet day for Bitcoin, which is really rare. So what do you know? You can have quiet days in Bitcoin. So right here is that level of support that I'm watching, 42,500. The 50-period moving average is moving up into it. We have the previous resistance. It clearly broke out of there, and it was never back tested. So, that to me makes a good opportunity trade. We haven't reached it yet. Okay, that's kind of annoying, but if we do, that's good an opportunity. If we don't, then, it is what it is. The reason why I'd want to wait and be patient is because I can have a stop right below it. I can risk $2,500 or 2,500 points, and if I get stopped out, whatever. And if I start seeing strength again, I can re-enter. Okay, there's a couple ways, you got to understand, if you get stopped out, you should be happy about getting stopped out, especially if it falls way down here, okay? Because then you can be like, wow, yeah, I only risk a little, and I could have lost a lot. That's how you got to consider trading certain investment vehicles. Now, the MACD, still bearish crossover, still heading down. It could, like I said, cross over here, and then we saw it really go back down into the 50 period. So maybe it's targeting the 50, or maybe it's waiting sideways a little bit for the 50 period to come up a little bit more. We'll see. We will see. Time will tell, but that's the only trade that I can see with it so far. Here's black gold, WTIC, light crude oil, very overbought on the weekly time frame. Here we are at 63.5. Holy moly. And this was at prior resistance, so we still haven't cracked above it, but it is trending very nicely here. And it's just been moving up considerably since early 2020, just up from, just crazy, just an insane move. Even 2021, this is just a huge move in the price of oil, and it could easily target in the 70s if we start breaking above this resistance. I've mapped that out on a monthly time frame. So look at the dollar. The dollar is up top. The S&P 500 is down here at the bottom. Down slightly today, but it was down even more and then found some strength. Now, this dashed gray line is where the year opened up. So we're still positive on the year. Remember, we were saying this looks like a little left head, right shoulder. Maybe this was the neckline. Well, that could have been a little false breakout. Still trending down, right? We're still lower highs. Until that changes, we're trending down still. So are we going to get some sort of weird spike in the dollar, and that's going to put pressure in the markets? We were down pretty significantly, and then when we spiked up, we even saw more pressure to the downside in the S&P 500, and that was with just being down here. And I've been saying we got to get above 92 to really start seeing the dollar, I would say shorts would cover more up in that range, but the lower it heads, they'd obviously be moving their stops down, at least I would expect. Let's look at bonds and yields. This is where it gets crazy, okay? All eyes have been on this. The 10 years at 1.54. What the heck? That moved fast. Holy moly, the 30 years up 4% at 2.33. You can see the curve, the 30 minus 5 actually went down because the 5-year spiked up pretty significantly as well. And then the 10 minus 2, which is widely tracked, is very, very well steepening. Now, steepening yield curves, financials do really well. The financials had a little bit of a pullback today, and that's to be expected. They need to take a breath, right? Because it's been a straight line, and we're coming into this area that I've been calling the red zone, because every time it gets up into the red zone, the BKW or BKX, or I'm losing my mind right now what it is, the regional, not the regional, that's the KRE. I'm blanking right now, but the one that I always show on the monthly time frame, the 24 largest institutions, that fund, is into a big area of resistance. It reached about 120 today, and I think it got rejected exactly from 120 flat, and the highest I think it's been is 120 and 16 cents. So interesting price action. If these continue to steepen, will we see it go higher? I'm not too sure. And at what point, now this is what's crazy to me. It's relatively speaking, right? We've been saying this, it's still low, right? We're finally getting back to around the 2020 range on the yields, the 10 and the 30. but it's still relatively low in the large scheme of things. But if it's this low and we're starting to see the markets react very poorly to this at this range, that's not a good sign. And that's why we've been saying, we looked at this chart right here, blew right through it today. This doesn't mean that it can't head down, but what's the market trying to do? What are they signaling? Do they really think the Powell's going to be raising interest rates to kind of cool this off? Is there going to be yield curve control? Is this going to continue to scream and then the markets are going to just completely there's going to be some sort of earthquake? It's way too hard to determine. But what you can do during these times is get prepared for either situation to take place. Right? So if this were to come down more or consolidate or continue to move up, you can understand that the equities markets like the S&P 500, the Dow Jones, and so forth, like we saw today, we saw a lot of drama take place. Okay, well, when there's a lot of drama here in the bond market, you can see right here up 14.93% on the week so far. Like, that's a lot of drama. All right, so you can expect to see a lot of drama too as well play out. Now, we've been saying if it comes up into these ranges, it's going to put pressure on the equity markets. And what do you know? It did today. Will it continue? Well, there's people that give their opinions and stuff like so. There's one analyst that said that he believes that it's going to reach 1.5 and then we're going to come back down to 1.0 to 1.2 or 1.15, that range, and then we'll continue a melt-up phase. Okay, but there's other people that think that this is going to continue to scream and until the markets pretty much just erupt. So you can listen to what people say, or you can just do what price action tells you to do. So you need to create a trade plan for both situations, which brings me to my conclusion. I'll just come back to this chart. Overall, technically speaking, how am I thinking about today? I'm thinking that there was a lot of drama, a lot of emotion. This could be very temporary, or it could be something that starts off to a bigger downside. Okay, as it stands right now, it's still above key trends, and some of the charts have not broken down. Meanwhile, some of them have broken down, like the IWM, and you can look at these on bigger time frames, the NDX, that's pretty scary there. So there are signs of weakness. Now, keep in mind, when bear market rallies or bear markets take place, you see some very large rallies. That's why when we saw this big thing right here, we said, well, remember, if that is the top, this right here could just be one of those large rallies. So there's a lot of opportunity even when the market falls. It's not just about shorting it and then watching, money get, in the bank. You can play bounces. You can play dead cat bounces. You can, which is shorting back down, or breakdowns of previous support. You can go long on bounces if you buy into areas of support. You need to be very tactful with how you play right now, because the fact is we're in a lot of chop. So for example, 2 days ago right here, we were already at this level. All right, and we were up at this level. So in 3 days, we just took a round trip from 12,800, up to 13,200 and then back down again. So if you just bought long here and then held it all the way back to here, you're back to even. So that could be frustrating. You got to understand, that's a lot of emotion. But if you were saw this and you're like, oh, we're overextended past the Bollinger Band. We're coming into an area of support. This makes sense. I'm going to go long. Up, we're coming back into this channel. That's an area of resistance. I'm going to scale out of the position. Okay, cool. So you locked in profits. Now you see it go down. And then there you go. So you captured profits to the upside. Now what you're looking for is breakdowns to continue and then little bounces to play throughout that, which, by the way, on Twitter, I'll be posting kind of my thought process throughout the days as time continues going forward. So, yeah, got to be careful, got to be tactful. Do not become emotional, okay? And if you are emotional about a trade, or you feel the need to be right, or you're becoming your ego's getting in the way, I tell you, you just got to, these market environments are very difficult to trade and very difficult to interact with. So once again, the warning's out there. Don't throw caution into the wind. That's all I got for you on today's market brief. Hopefully everybody has a great day.